Welcome to Cucking with Jmo.
All right, guys, welcome to another episode of Cucking with Jmo. Today we have Anders from marginfi. Anders, how you doing today?
Good. Thanks for having me.
Before we get started on talking about marginfi, give me a little bit about your background as to how you got into crypto.
Sure. Yeah. So I started following crypto like way back in like 2017 when I was in high school, but I wasn't like super like technically in tune with how anything worked at the time. So kind of like brushed it off and then picked it back up like around 2020-ish. And then was just like following along while I was in school. And then I had a buddy get a job in the space. And so he like dropped out and was like telling me kind of how exciting it was working in there. And then like November 21, like very top, ended up joining marginfi as like one of the first hires. And yeah, has gone from there. So it's been almost 2 years now. We ended up starting another company together. And then we have grown quite a bit. I think we'll probably talk a little bit more about that on this podcast, but that's kind of how it all started.
So for the listeners or watchers who don't know, marginfi is at its core, I think, a borrow-lend platform with, I'd say, a unique take on the whole borrow-lend DApp economy, and it's built on Solana. So I guess the first question today is, what was the thought process of building on Solana versus, let's just say, Ethereum or other layer ones or even Ethereum layer twos? What initially drew you guys to the Solana chain?
Yeah, I think with Solana, it's obviously like a performance pitch, and I think when you really start like diving into the metrics behind everything, it's kind of ridiculous just how much better Solana is from like just like a raw throughput perspective, and that's only going to get better over time with things like Firedancer. So like if you look at like L2 TPS or fees, like it's like a 10x 100x difference. And then even on the like decentralization side, because like everyone tries to claim that, like, you know, with your trilemma, like, oh, Solana's like fast, but it's like
It's
this
centralized.
yeah, and then they're running like one server on AWS for their sequencer and then calling that like crypto somehow. So like even on that side, it's like surprisingly decentralized. And so I think the performance is so compelling, and even if you like use it, it's kind of funny, like once every quarter when there's something like actually interesting, like from a trading perspective, that happens on Solana, like all these people that trade on ETH will come over and they'll tweet like, oh, I forgot how like fast and nice to use this is. So I think that like it's very, very new. Like it only launched like March 2020, whereas ETH was like 2014, 2015-ish. And so that's like quite a bit of time when you consider like how quickly these technologies compound. I think it's like a lot of people are kind of fading it because of that, but I think that the tech is just like so compelling, and it's still so early in its life cycle that it's just too attractive not to see kind of what could happen with this ecosystem.
Yeah, that makes sense. We talk a lot about various layer ones on this podcast, and the one criticism a lot of people have of Ethereum or even Ethereum layer twos is that it prices out quite a bit of the population that, you know, doesn't have hundreds of thousands of dollars to be transacting on a daily basis, which is, in my eyes, fundamental for at least the growth of protocols, but also bringing in new users that, you know, want to use crypto, want to interact with decentralized finance, but, you know, don't have that type of money to put in as their initial capital. So I guess talk a little bit about marginfi, exactly what you guys are trying to build, and I guess a little bit about how you differentiate yourself with the other like major borrow lend platforms or the major DeFi platforms in the space.
Yeah, so marginfi has always been a lending protocol of sorts. So when we first launched, it was like the prime brokerage model. So we allowed people to trade on different perp dexes and then cross margin between them. So you could be like long the Drift Sol perp and short the Mango SOL perp, and you could be like delta neutral on 2 different exchanges. So we like did that, and then that was 2022. So it was like exchanges were blowing up left and right, and like market makers were pausing because of different stuff. And so by the end of the year, it was just like everything was kind of paused more or less. And so we said like, all right, like we built this, but it doesn't seem like this is kind of where the market is for this type of platform. But we thought that just like the very like kind of core borrow lend, like over collateralized compound type experience could be improved upon. And so we specifically looked at like the risk management side and how can we like avoid a lot of these like kind of frightening liquidation scenarios that have happened with borrow lends. Like you look at like Aave with the Curve founders position, or like there's still that
depositing like half
yeah
the float of Curve into one pool.
yeah, and then just yoinking like 100 mil out of it on the other side.
Yeah.
There's like that Venus account still. There's like the Solend Alameda account, and that's like it doesn't. You don't need to be that sophisticated to know that like someone probably shouldn't borrow 100 mil against something that's illiquid. But there's a lot of other interesting stuff I could talk about that we do. So yeah, we launched this like over collateralized thing in February of this year. So still somewhat recently, and then yeah, just been growing it from here. And then I think that like it's a pretty simple product right now. There's like a lot of more interesting stuff going on in the background with it, but definitely like hoping to bring back the like Prime offering, and then we have a couple other products we're looking to launch around it as well.
Yeah, very cool. So on that note, I wanted to talk a little bit about risk management. I feel like risk management on a lot of these borrow lend platforms, as you alluded to earlier, is really important just because it's very easy to generate bad debt on the platform. Basically, the way debt is generated is someone deposits a large position in a semi-illiquid coin that they borrow like a real asset, and then the price of the liquid coin gets to a point where it needs to be liquidated, but there's enough liquidity possibly on chain for liquidation. So a lot of the bigger platforms have had this issue. I know marginfi does a few things. So they have different collateral weight based on asset. They also have like isolated pools versus global pools. And I feel like they're pretty selective in terms of what assets they put a lot of weight on, or even what assets they list as, you know, like a borrow lend pair. So yeah, talk a little bit about what the process is like, or how marginfi handled this. I mean, like if how does marginfi essentially decide which coins can be used as collateral, which ones can be used as cross collateral, and then the whole collateral weight percentage? Basically, collateral weight means if you deposit a certain amount of the asset, what percentage of that asset can be used as like a USD value collateral for a borrow. Yeah, so talk a little bit about that.
Yeah, so I'd say the like core of the risk engine is we have this really good picture of like liquidity on chain in real time. So like for any given token we have, we know like second by second like how much could be sold into the market at like what slippage and then what depth. And so you like need that to know what you can liquidate without incurring bad debt. And so that like liquidity data is kind of the foundation of everything. And so from there we can set like different collateral weights based on it. We can set deposit caps. And then as far as the listing process goes, so it was like pretty conservative, but with this this isolated pool model, it like really silos the risk because we don't have to like liquidate whatever like shitcoin someone is trying to borrow against. Like if you just say like, oh, you can borrow that, well, then you don't have to like worry about the liquidity as much. And so we started listing like more of those. Like we listed that like Opos coin, I think maybe 36 hours after it went live. And then this week we're just like listing one token a day. So I think that with like all this risk stuff, we definitely want to like use it so that you can have a better experience as a user, even if it's like a smaller market. Because if like the whole pitch is we just say like, oh, you can't borrow as much. Like, yeah, maybe
Hmm.
it's safer, but people probably won't be as
Yeah.
excited about that. So now what we're doing is we're going like really wide with the listings, and then we've been doing a bunch of new simulations recently. I think we'll be able to offer like more leverage on kind of like your blue chip tokens than you'd be able to get on other protocols.
Yeah, I think that's an important concept. People have to, or at least protocols have to juggle a little bit because the end user wants to be as capital efficient as possible with like their collateral and what they're doing. But then the protocol has to also take into consideration the the overall risk of that asset being used as collateral and figure out a sort of middle ground where it allows the user to be capital efficient, but it also protects the protocol from, basically going under if large positions are unable to be liquidated. So I was a little bit curious about um, the idea of the isolated pools versus the global pools and the collateral weight. Is there a process in which you decide a certain asset goes in an isolated pool versus not? Just because I'm thinking if you're worried about the liquidity of an asset to a point where you put it in an isolated pool, it seems like you can also just lower the collateral weight quite a bit to a point where like the liquidation risk is far less and still have it in a global pool.
Yeah, so we start every asset we list as an isolated pool, just to kind of like ease it into the protocol, if you will.
Hmm.
And so like there's a few tokens in there right now that have like really good like relative amounts of liquidity, and they'll probably get upgraded in the future. It's kind
Hmm.
of nice, like the way it's set up is we can basically just like update a line of code, and then like no one has to like migrate their assets or anything like that
Hmm.
when it does move to the main pool. But yeah, what we do is we'll start everything in as an isolated pool, and then just based on like various outputs from the risk model, then we can like up it, and it could be turned into something that's like collateral for users.
Hmm. And then all the liquidations that happen are handled on Solana. Essentially, Dex is built on Solana. Like there's any settlement off chain.
Yeah, so every like all of our risk model stuff, and then is based on on-chain liquidity because
Hmm.
we only have like on-chain liquidators right now, and then
Hmm.
we've explored with some parties building out like off-chain liquidations.
Hmm.
That's not live right now, but that would for some assets like say just like spot sol, that would obviously unlock a lot more liquidity, and then
Hmm.
maybe like the LSTs as well because you can turn them into spot
Yeah,
sol.
yeah,
Um,
that definitely makes sense.
yeah,
So
so
in
yeah.
sorry, go ahead.
No, yeah, we it's not live right now, but I think we definitely want to explore like off-chain liquidations just because it'd be way more throughput for everything.
Wow. So I haven't used Solana dexes that much since basically since FTX blew up, and then like I was used at the time I was using stuff like Serum, Orca. I forget which exact ones were on Solana. But one issue I feel that Solana decentralized finance has always had was the on-chain liquidity was, basically a small fraction of what it is on ETH or even Ethereum layer twos. Do you guys find that as sort of restraining to what you can do on your platform?
Yeah, I mean, so it's definitely way less liquid, and since like everything we built the risk on is based on liquidity, like the
Uh-huh.
caps are a lot smaller. So I think like if we just like didn't care and we just said like no caps, we could grow a lot more, but you just like can't liquidate all of that in a
Hmm.
reasonable fashion. And so it's a constraint right now, but I think that there's like there's a lot of paths to that improving in the future, and it's already starting to improve. So like a lot of the assets we have, they've like gradually increased caps over time just because
Hmm.
liquidity's generally been trending upward again. um, but yeah, it's definitely like a very nascent ecosystem for that perspective.
Have you had any situations, I guess not to the scale of, say, the Solend situation where with a deposit of Solana and borrowing USD, but have you had any like pretty big positions on your protocol where at some point it felt like at least it got a little bit risky, and you're scrambling a little bit to make sure that if a liquidation did happen, it wouldn't cause bad debt on the platform.
Um, Not really, honestly, because that
Uh-huh.
was like the whole thing we were trying to prevent. And we
Yeah.
have like a couple like multi-million-dollar accounts like with borrows on them on the platform right now. But yeah, we haven't had like one account that we're like, oh, this could be a serious problem, just because like that was the whole idea, is you like never make it
Yeah.
have the potential to be a problem. So we'll see. I mean, we're monitoring everything, but so far like haven't seen it happen.
Yeah, I guess that's good if if like the end goal of the protocol, if you go into it thinking that we need to avoid situations like this, it may stunt the growth of the protocol a little bit, but like at the end of the day, it's better to, have an operational protocol than to blow it out with like one or two large positions that basically destroy a protocol.
Yep, that's the trade-off we're making right now. Um, and I think that like DeFi needs to evolve like that a little bit. Like last cycle, like everyone just got so levered on chain and off chain, and I think like every cycle people get levered, but I think that there's like a bit more sophisticated ways to go about it, and it doesn't need to have these like crazy untanglings every time.
Hmm. Yeah, so next, wanted to talk a little bit about how the collateral on the flat platform, at least the Oracle pricing works. I know with a lot of other borrow lend platforms, a big issue was so basically in general, these platforms use a Oracle price to determine the value of the collateral to a point where if it gets in liquidation range, it gets flagged or it gets liquidated. There have been quite a few issues in the past with other platforms where either the Oracle price isn't in sync with the on-chain price, like the global Oracle price can spit out one number, but like at the point of liquidation, the number can be completely different, or like certain outliers in pricing cause liquidations that shouldn't happen, even on chain, just because like the Oracle price spits out the wrong the Oracle feed spits out the wrong price. So talk a little bit about like your Oracle providers and how you handle risk for that.
Yeah, so we use Pith where we can, and then we use Switchboard for the like longer tail stuff that's not supported by Pith.
Hmm.
And one of the things Pith does that they added a little while ago now, but I think it's still like kind of under discussed, is they have these like confidence intervals for prices. So if you
Hmm.
go on our app and you like expand the detail on it, you can like see in real time the like band that it's spitting out, and basically
Hmm.
that's just saying that like if we had to put one price on it, it would be like this Oracle price, but it's
Hmm.
probably like somewhere within this range. And so for the assets in the main pool, what we do is when you're like borrowing against one of those, we'll take the bottom of that, just saying like, all right, this is probably worth like, we're gonna assume this is worth like the least amount possible. And then when you're borrowing it, it takes the top of it. So it's saying
Hmm.
like, we're gonna assume this is like as big of a position as it might be. So by like using that range, that's like kind of max conservative on our end to take
Hmm.
it's not like taking a spread, but basically taking like the
A certain
boundaries of that.
confidence interval to reduce risk based on exactly like what the asset is and what you want to do with it, either borrowing or providing collateral.
Yeah, yeah, exactly. So that's like main pool. And I think the intervals make it like harder to manipulate in general. But I guess like the bigger vector for manipulation is something that's like very low liquidity. Where maybe the pool has like 100K, like someone could definitely mess with that if they wanted to.
Hmm.
And so that's why we just like don't we don't put everything in the main pool, is because like
Uh-huh.
if someone could easily manipulate it, then obviously there's like there's been many such cases of that where
Yeah, for
it's like
sure.
something illiquid, and then someone just like corners supply and then borrows all of the stables against it that are in the platform.
Is there something specific about Pith that you guys like to choose them as your Oracle provider? I only ask this because if you ask a lot of at least the big DeFi players, mostly Ethereum based, that they'll tell you that basically if you don't run your platform using the Chainlink Oracle, you're you're basically open to Oracle manipulation and hacks, and then every time another third-party Oracle gets, exploited, I feel like is the wrong word, but like the Oracle price causes issues on a platform. Those people are going to be the most vocal on crypto Twitter, telling you that like this is obviously going to happen because you're not using Chainlink. Yeah, so talk a little bit about Pith and like I guess the unique advantages it has for what you're trying to do.
Yeah, so I think I would put Pith and Chainlink in the same bucket, and then Switchboard's the other one we use, and that's like a little
Hmm.
different because both Pith and Chainlink they'll pull from like off-chain venues, right? So like it'll take the Solana price on like Orca and say Phoenix, but also take like the Coinbase, Bybit, OKX, like all those other prices, which
Yeah.
you're not going to be able to like manipulate all of those all at once unless you have
Hmm.
like very serious capital to do something like that. So Chainlink does that as well, and that's like actually that's what saved the Curve founder and Aave is because Curve was
Hmm.
getting like dumped on
Yeah,
chain,
yeah,
and it was like below his price, but on
yeah, yeah.
Binance or whatever, it's like just a little
Yeah,
bit above, and
the
so it
spread
like
the spread
netted
between
out.
Curve
Yeah,
on centralized exchanges and like the DEXs was like I think like 40 or 50% at one point, which is insane for such a liquid coin.
yeah, right. I don't know how that didn't. I mean, it get closed eventually, but pretty crazy
Yeah.
orb there. So yeah, that's why we use Pith is just because they do that. And then I haven't seen. I only remember one like Pith exploit, and it wasn't really Pith's fault. Basically, like the protocol using Pith didn't use like those confidence intervals we were talking
Yeah.
about, and so like when you just like take one price,
Yeah.
it's just way more vulnerable. So yeah, that's the thought there.
Yeah, I actually remember that, and I feel like a lot of people really went at Pith after that happened without understanding the nuances or the details of the exploit. Basically, at the point where an Oracle price is like a price is fed, a lot more goes into it than the raw number being correct or incorrect, and I feel like that's what people don't realize. I mean, because like I feel like that there are thousands and thousands of crypto markets, and a lot of them are inefficient. It's really difficult to figure out like a correct formula or like a universal formula to get the accurate price feed for certain assets, just because they move around so much, but also like the markets can be quite disconnected at times. So a lot of these Oracle exploits that people blame on the Oracle provider, I feel like at least a decent portion of them aren't really um, a problem that the Oracle provider caused, rather than like internal risk management or figuring out how to interpret data from the Oracle provider.
Yeah, I think at least on Solana, a lot of the recent exploits or like the headliner ones in 22, they were like on the surface Oracle related, but when you start like peeling back a couple layers, you realized it's not just because the Oracle gave out a bad price. Like there's a lot of other steps in how they designed their protocol that led to different issues.
Yeah. So, is there anything that marginfi is developing or in the works that additional features, additional use cases, stuff like that that you think may gain adoption or sort of change the landscape on at least Solana, how people interact with DeFi?
Yeah, so our most recent launch was we made a liquid staking token.
Hmm.
And what's different about this is it's like totally focused on just like highest yield possible.
Hmm.
So it's kind of cool because all of the LSTs on Solana, or I'd say like 90% of them are built on the same like stake pool contract. And
Hmm.
what that lets you do is there's this like big pool of Solana called Sanctum. And what they do is you can take like any LST then, and you can instantly redeem it for Sol.
Hmm.
Since they're all the same contract, it's not like it's not like on ETH where you get these like liquidity modes with different LSTs.
Yeah.
So because of this deposit that's on Sanctum, it's not, you don't have like this Lido situation where like
Hmm.
Lido's the most liquid LST
Yeah.
and then like no one's gonna compete with that. So because of that, we could just like launch an LST without like any bootstrapping, and it's like
Hmm.
already in the main pool, and there's like I don't know, a couple hundred K that's getting borrowed against on there. Um, but I think what's going to happen with LSTs on Solana is they're going to become like specialized in a way, because you won't have that like liquidity mode. Yeah, I think it's going to get like way more specialized. And so the like niche we went for was just performance. And the way we did that is it just stakes to 3 validators. And if you look at like the Solana validator comparison, like
Hmm.
all 3 of them are like, or actually it really only sticks to 2. They're like in the top 20, top 10 of performance all the time.
Uh-huh.
And then those validators take 0 commission. And then the stake pool takes 0 commission. Because
Okay.
normally what you get is like your LST, it's going to stake to like, 100 validators,
Hmm.
because it's like decentralized, which is good. And then all those validators, they take like 8%. And then the LST provider takes like another 6%. So
Hmm.
you're getting like very variable performance, and you're getting clipped on fees like by a ton of different providers.
Hmm.
Whereas this one, it's like we're gonna give you like the best yield, and then like nothing's getting squeezed out of that. So you get like the experience of just vanilla staking with like a best validator, but then it's like liquid. So
Uh-huh.
just did that. It's like it's yielding like 8% on an LST, and like most of the other ones are like mid sixes. So it's actually like
Hmm.
a pretty significant bump.
Yeah.
But that was more of like that's not like a huge lift of a product to build. That was actually pretty straightforward.
Hmm.
So we did that, and then we're looking to do a stable coin as well. So like
Hmm.
yield bearing stable coin off of the staking emissions. So kind of like a like Libra type thing.
Okay.
But that could be like minted against your existing deposits in marginfi.
So
Um,
so the yield comes from the Solana staking?
yeah, yeah, yeah.
Okay. Okay.
Yeah, and that's like on ETH, it's like 4-ish%, but on
Yeah.
Solana, right, like ours is doing like 8.2%. So when
Uh-huh.
that's like over collateralized, right, then you have like that much yield going to a smaller amount of stablecoins. It should be like pretty compelling, and that's like very sustainable, like real yield
Yeah.
coming from those emissions. So very excited about that. That's in the works. And then as we see like more perp dexes get liquidity, we'll bring back the prime
Hmm.
offering. So like Drift's been doing really well
Yeah.
recently, but you don't like need you need like another venue to cross margin it against for the
Yeah.
original one. So as we see like Mango or like someone else like that pick up, then we can bring that back, and then there's like a bunch of cool like funding
Hmm.
rate strategies, stuff like that you can do with marginfi.
Do you have any thoughts on the general state of Solana decentralized finance right now? So like a recap of the past few years. Basically, a lot of the initial Solana decentralized finance was, I wouldn't say incentivized, but it was funded by like Alameda Ventures, FTX. A lot of the projects were that their seed rounds were bought up by them. Like one of the easiest ways, at least most people I know, that got assets on Solana was essentially to use the FTX exchange as a bridge. You deposit whatever asset on FTX, you could withdraw it on Solana. Other than that, I guess you would use like the Ren bridge, which is now non-existent for BTC. You could use Wormhole. So it seems like after the FTX collapse, at least, Solana as a whole fell off quite a bit in terms of TVL, but also in terms of like the users moving to other chains, losing belief in Solana. And then I feel like in the past maybe 6 to 9 months, there's been like quite a bit of resurgence on Solana projects that maybe launched after FTX or weren't funded by FTX or Alameda. Obviously, like the valuation of Solana and like the VC money isn't nearly what it used to be, but it feels like there are quite a few projects that are developing on Solana that, like you said at the beginning, realize that Solana, operationally speaking, is a superior chain, at least in its current form, than a majority, if not all, the other layer ones that are being used right now in terms of speed, throughput, fees, stuff like that. So yeah, just I guess talk a little bit about like the current state of decentralized finance in Solana, maybe some like other protocols outside marginfi that you like or you're bullish on that may, gain market share or provide like a unique decentralized finance experience that you can't really have anywhere else.
Yeah, so I definitely agree. There's been a resurgence of sorts, because I think there's like a handful of teams that, like after everything blew up, like they're still building, and they weren't like funded by FTX, like you were saying, and
Hmm.
it just took like a little bit for that to become more apparent. So I think we're seeing it. I think there's like this cult around Solana's tech at this point, and
Yeah.
people who like refuse to build anywhere else because they have just enough conviction in what Solana can do. And so I think that kind of explains the recent traction, but I don't think that it's without headwinds. So I think the obvious one is like liquidity.
Hmm.
One of the big blockers to that is it's like quite hard to bridge to Solana, honestly.
Hmm.
Like if you want to like move, 10K of USDC, that's like pretty straightforward. But to like really grow a DeFi ecosystem, you need like much larger players, and
Hmm.
moving like any significant amount of liquidity is surprisingly hard.
Hmm.
But I do think that with like Circle's CCTP and
Hmm.
then like Layer Zero, both of those integrations are slotted. So um, I think the Circle one should definitely be happening this year. The Layer Zero one, I've been hearing it's going to happen for like, I don't know, 16 months now or something. So I'm kind of like, if it happens, I'll be stoked, but I don't know if
Yeah.
it is happening. So there's like the bridging environment. And then I think the biggest thing though is it's in a very primitive phase, because basically all of the primitives were made by like the Machianos back in fall of 21, and then they
Yeah.
all broke, and so now everyone's like remaking primitives.
Yeah.
And so the joke is like, oh, all you can do on Solana is like stake and lend Sol, which there's like some truth to that, but I think
Hmm.
that will change. So yeah, I think like the two big things that need to happen are, one, like start making a bit more exotic or interesting of protocols, and then two, like kind of the main driver with that is like people need to launch tokens for these things,
Hmm.
because right now there's uh like all of these like 2.0 protocols, or like the ones you've probably been seeing on Twitter, like Jito, Camino, Drift, like none of
Hmm.
them have tokens.
Yeah.
And when like every project elsewhere has a token and like none of the ones on Solana do, it's quite hard to compete for that mind share, just because people want to be able to align
Yeah.
incentives with teams.
Yeah, yeah, that definitely makes sense. Yeah, so to expand on the whole bridging aspect, I feel like one of the reasons why Solana doesn't gain a larger market share is, well, like you said, the whole bridging, moving assets there is kind of difficult to do. So if you look at, say, Ethereum, if you look at all the orthogonal layer ones or even the layer twos, they're all essentially the same virtual machine, right? They're all EVM compatible. So like if you want to deposit whatever asset onto a bridge to use on another chain, you're using the same wallet. You just like look up the same asset on the other chain, and the process is a bit seamless. Do you think there is or should be a solution coming out for Solana that draws these users that I feel like basically don't have, like the time or energy or the want to figure out how to bridge and more importantly, I guess, bridge securely from other chains of Solana to use the protocols on Solana?
Yeah, so there's a few things there. So I think there's the new bridges, like we were talking about,
Hmm.
that should help liquidity quite a bit. And then I think there's just like some more kind of UX type things to do. So like one of them is there's like MetaMask support for Solana now with this like
Hmm.
Snap feature. And I think that helps, because otherwise like people might have to make a new wallet. A lot of the other wallets though, they're like multi-chain at this point. So
Yeah.
if you're using like Coinbase or OKX or something like that, like it'll support both out the gate. Um, But yeah, I think it's like bridge liquidity is a big problem. And then I think people will bridge because like if you go to like Arbitrum from ETH, like yeah, it's still EVM and it's settling to ETH, but like really you just bridge to another chain more or less. Like
Hmm.
it's like from a user perspective, right? Like you're still sending funds somewhere else and waiting a few minutes. Like it doesn't matter if it's like Arbitrum or Solana.
Yeah.
Like yes, the token standards will be different, and so, but I think that's something that can be like solved with better UX. So
Hmm.
I'm a little bit less worried about that like user pattern. I don't know.
Hmm. So I think I guess there's like a current rage right now in crypto for like a multi-chain ecosystem or a cross-chain ecosystem where people are building protocols that not only interact with like the native chain that they're on, but can interact with like various other chains. And I think the lend borrow space is a great example of this, where you can deposit as like a little, collateral on one chain, but if you need liquidity on another chain, you can use that collateral as collateral on another chain and borrow assets from that other chain. And I feel like that's a pretty big use case, just because liquidity right now is a bit fragmented, and to a point where I feel like there are going to be quite a few layer ones or layer twos, whatever you want to call them, that gain some sort of market share, especially if we go into another bull run. Like all the action isn't going to be on ETH layer one. I mean, we've seen that in the past, and I think we'll see it in the future. So, has marginfi ever considered either going cross chain or building their platform on, say, like another chain?
Yeah, I think we've been considering it for a while now, just because I think it is pretty clear like where the liquidity is today, and so we haven't started developing anything elsewhere, but I think it's like kind of a constant consideration,
Mm-hmm.
uh, just because there's like a lot more money flowing through some of these other ones. I do think in the long run though, it'll probably be. I think like I don't see how you can have like 50 or 100 L2s and like
Yeah,
all of
there
these
aren't enough
all
people.
tell once.
Yeah,
Yeah, no, I feel like a lot of them got to go to zero, and
yeah.
it'll just be like the kind of core L2s and then Solana and then maybe Cosmos keeps surviving because it
Hmm.
just refuses to go away. But I
Yeah.
do think that like 22, 23, there's just been so much like infrastructure investment, and these
Yeah.
VCs get away with like funding things at 200 million and then opening them at 10 billion. And I really hope that that pattern can stop, because if you look at like the usage of these new chains, like just no one is
Yeah.
even like wanting to try them out at all. So I hope the
Yeah.
market starts to like relax to this, but they seem to keep getting away with it. So I don't know. I
Yeah.
imagine there'll be consolidation.
Yeah, I feel like that was the thesis for a lot of these venture funds in the past few years, was to invest in these, technologically advanced layer ones or layer twos at like lower valuations. And then I think if you look at the user activity, so like one thing I've always considered is the baseline technology of any chain doesn't, or almost never equates to its success as a chain. Like the chain with the best technology doesn't have the most users, or it doesn't have like the biggest ecosystem built around it. There are like tons of other factors that contribute it to a point where like the actual technology, just because like a lot, especially like if you're talking about Ethereum rollups, a lot of them like there are minute differences in the roll-up technology that change like a small amount of the fee structure, or whatever you want to call it. But like to the end user, um, they probably can't distinguish like one layer two roll up from another just by using it and thinking that this one is better than this one. It's essentially what's built on the layer two or layer one, and how many people are using it, and if it's like profitable or fun, or if there's some use case that draws users there.
Yeah, I do think the performance isn't enough. And I know I like opened this with like the Solana performance pitch, but I do think Solana is like really cemented itself as like the strongest contestant, and I think that's like a testament to the community there and the builder ecosystem. Like right now, when people talk about base layers, it's like Bitcoin, ETH, and Solana. It's not like
Yeah.
Bitcoin, ETH, Arbitrum, or Bitcoin,
Yeah.
ETH, and Say or something. So I do think that like if someone's gonna get that kind of traction, it'll be Solana. So that's the bet there. But yeah, I think the other thing is like Solana is like a 100x on Ethereum in terms of like speed, fees.
Hmm.
Uh, I think it's like arguably more decentralized at this point too. Maybe I don't want to open that discussion, but
Yeah.
um, so it's like a massive, massive increase, right? And then
Yeah.
like, you know, DeFi roll up app chain number 24 pops up and it's like, oh, it's like 5% cheaper. It's like, like why
Yeah.
would you really care? There's nothing you could do there. So it's like these marginal improvements versus like step function ones that I think make all of these newer ones a lot less compelling.
Does Solana still get quite a bit of hate for, I mean, quote unquote, being centralized? I feel like it's just such a stupid metric. Like when people talk about it, because the way people talk about it, it's like a binary thing. You're either centralized or you're not, which like it isn't the case, right? Every chain is somewhat centralized and somewhat decentralized depending on exactly how it works. And I don't feel like you can assign, like a label of Solana is centralized, Ethereum is decentralized with good faith.
Yeah, it still gets quite a bit of hate because people say the like validator specs are cost prohibitive. And it's not like cheap to run a Solana validator because you
Hmm.
need like I think you can do it for someone has a new offering where it's like 250 a month for the box and then it's like one sol per epoch voting.
Hmm.
Um, but I don't know. These people are like, oh, you should be able to like run Ethereum on a toaster, and then like the problem is like you have fucking like Lido has 30%,
Yeah.
and then like the block builders are like censoring
Uh-huh.
Tornado Cash transact. Like
Yeah.
it's like,
Yeah.
oh yeah, I'm running ETH on my Apple Watch, but I can't send the transaction I want to because it's like being censored by U.S. entities. So I think there's like a ton of virtue signaling there. Um, so yeah, like the TLDR is like Solana is getting easier to run a validator on every day, and
Hmm.
I think ETH is becoming increasingly centralized by
Hmm.
a couple different forces, both on the
Yeah.
liquid staking and MEV side.
Yeah.
And then even if you look at like some of these other like EVM ones, like if you look at I remember Phantom, you needed like 8 figures of tokens to run a
Yeah.
validator with that.
Yeah.
Yeah, so it's like I don't know. It doesn't
Yeah,
feel
I remember
super
looking at Phantom
decentralized.
once, and I think like one of my friends who's like really into Phantom told me that basically like a third of the validators were basically at one point just run by the same person or the same entity. So I mean like it's also difficult. That's another thing I feel like it's also difficult to determine decentralization just by like number of validators, just because you don't know like how many entities own certain parts of the chain.
Yeah, definitely.
So a few more questions before we call it a day. Going back to the LSTs on Solana, I feel like the LSD game, at least on Solana, has taken off like quite a bit, surprisingly, for me at least, in the past few months. There are quite a few more, and not only that, there seems to be like a legitimate decentralized finance ecosystem built around them. How do you see this all playing out with so many of them popping up and attempting to gain market share? Are you bullish on like one or two, or how do you see the whole landscape ending?
Yeah, so it definitely I think that has been kind of the story of the last few months. And I think it's super important for Solana because you have like so much money just staked in validators. And
Hmm.
when you have like all of that locked up, like you can't have other activity going on with those tokens. And so I think like the use case for LSTs is pretty clear. And then kind of the way it started to get exciting was there's this like BSOL, which
Hmm.
is like maybe the fifth largest one, I want to say.
Hmm.
They did an airdrop and they have some like interesting mechanisms around that. And then there's like Jito Sol, obviously, is the big one, who's now I think number 2 in TVL on Solana. And then yeah, like the thing with Jito is they unlocked this. They made like the whole like Mev tip marketplace on Solana, and then originally like only Jito Sol holders got those rewards. But now it's funny because like all the LSTs, pretty much all of them are getting Mev right now, but Jito has like the branding very secured on that.
Yeah.
So it's funny. Actually, like some of them will outperform Jito, but people think that like Jito's the only one getting Mev. So as far as like how I see it playing out, I do think that liquidity is fairly commoditized. Some people definitely have like Jito and Marinade have more liquidity than others, and there's like some benefits to that. But I do think that we'll see like increasingly specialized LSTs for different use cases. So there's like what we're doing, which is like just like a raw performance use case. There's one called like DAO Sol that stakes to just like community run validators. And like I don't know if that's gonna like change the world, but I think it showcases that like you can have LSTs that like fit different niches. So yeah, I think it's super important for the chain, but I also think it's gonna be kind of a race to zero and get commoditized, and be more of like a public good than anything.
Yeah, I guess that was my next question. Do you think with like all these popping up, it's just going to be like a race to the bottom for people to provide, an LST with lower fees, sharing more of the MEV revenue, basically one-upping the current top player in order to gain market share to a point where I guess it's going to be good for the end user. But in general, like you can always reduce fees, you can always make something slightly better in order to one up your competition.
Yeah, that's kind of the experiment we started, because we just like came out the gate and just like slashed everything to zero, and we're getting traction so far. I do think that like there's a bigger user education problem with LSTs, because I think like some people like still don't even know what like MSOL is, much less like how Jito Sol is different from like B-Sol or something like that. So I think that while like the builders in the ecosystem love to like debate these small tweaks between the different ones, there's still like a lot of people who don't even know like why they should care about these in the first place. And so yeah, there's like I think there's like bigger problems to solve on that front. But I do think we're like trying this just like zero everything out thing, and we'll see how it goes from there.
All right. One final question before I let you go today. Are there any projects or protocols outside of marginfi on Solana that you're especially, I guess, bullish on, but also possibly have like founders that may be good guests for future podcasts we do?
Yeah. So definitely the Jito team. They have a really interesting background. They've gotten a ton of traction on the DeFi side with their LST, like being number 2 now, but it's also like that's not really their core product. So overall, really cool team. Their founder Lucas was like a searcher on ETH before, so I think he has some pretty cool stories from that. And then the Drift team is really cool too. They have like one of the best perp dexes, I think, and their founders were like traders at different prop funds and banks before, so they have cool backgrounds. And then I think Camino's doing some interesting stuff as well, taking like that's like kind of an only possible on Solana use case as well. The like rebalancing they're doing on different AMMs, and it seems like they're like it's much more profitable for users, much less in permanent loss than just like if you just deposited and left there. So pretty cool product there as well.
It's something you definitely can't do on Ethereum, just because like the transaction fees would, I mean, you would have to do mass amounts of volume to counteract the transaction fees for like one simple rebalance.
Yep. Yeah, exactly. I could go on about the fees thing, but I think that that's like a underexplored space. I think there's like a lot of cool things people
Yeah, yeah.
guys could
I
do with
definitely
it.
agree. Like if you have a like a very fast chain that has very low fees, like the possibilities of what you can build are far, far greater than like a chain that's constrained by both throughput and like the user fees.
Yeah, definitely.
All right, I think that's all we have for today. Before we let you go, you want to let the listeners or watchers know where to find you?
Yeah, yeah. You can follow us on Twitter at marginfi, and then we've got like site link there and Telegram and stuff. So yeah, at marginfi on Twitter. Uh, yeah,
Oh, and one other question, because I've actually had this issue. If someone wanted to use MarginFi, but aren't involved in Solana right now, but are like, let's say, like an Ethereum user, like an Arbitrum Ethereum Layer 2 user, what's the process? What's the best way to, move assets over? What's the best wallet? Stuff like that in your opinion?
yeah. I would just get Phantom Wallet, honestly. Um, and then what you can do is if you once you have that like all set up, if you go to our site, we have like a bridge in the
Hmm.
app, and it's like super nice to use. It's not like the old wormhole portal UI. I don't know if you guys have used that, but that thing
I've
was
used that, yeah.
yeah, no, I don't want to use that ever again. So yeah, we have like a bridge in the app, and you can bridge like ETH and stables, and you can like bridge like ETH on say Arbitrum, and it'll swap it to Solana for you, like with the
Hmm.
best routing it can find, like while it's bridging. So definitely try out like the bridge we have in our app, and yeah, I just get Phantom and play around from there.
All right, cool. I appreciate your time. We hope to have more guests on in the future with Solana ecosystem projects. We're chain agnostic here. We talk to basically people developing on all chains, and we're actually pretty happy with the people that are building on Solana and doing good stuff there.
Cool. Yeah, thanks for having me. Happy you guys are like open to hearing about new things, and yeah, hopefully we can get some more Solana adoption going.